Welcome to Market Decoded, where together we decode the mysteries of global cash flow, understand the laws of market cycles, and uncover strategies to protect your wealth during the most volatile periods in history. Today, we are going to dive deep into a topic of absolute survival for anyone holding assets: the resurgence of the 1923 scenario, and the question of whether gold is silently accumulating momentum for a historic leap. This analysis will provide you with a complete mental roadmap, seamlessly divided into 5 parts, helping you see through the underlying structure of the economy rather than merely drifting along the surface waves. Part 1. The warning from the market's underlying structure. There are periods when the global financial markets look like a perfectly well-oiled machine. Stock indices continue to fluctuate, earnings reports are published on schedule, and the retail crowd remains absorbed in the short-term waves of green and red on their screens. However, through the analytical lens of Market Decoded, this is often the exact moment when the foundational structure of the market is at its most vulnerable. Beneath that deceptive surface of calm, massive fractures in liquidity and systemic trust are silently forming. The faith in fiat money and in the ultimate backing power of central banks has actually been fracturing for a long time. Centuries of historical data point to an undeniable rule. It is precisely during these moments when the market seems fast asleep that smart money begins a massive, stealthy rotation of assets. The only problem is that retail investors are always the last ones to receive the signal. This is exactly why today, Market Decoded must dissect a concept that is heating up by the day: the 1923 scenario. This is not some sensationalist conspiracy theory. It is the convergence of multiple macroeconomic data points flashing warning signs simultaneously. The U.S. national debt is swelling to alarming levels. Core inflation is proving to be incredibly sticky. The geopolitical map is fracturing, and institutional capital is frantically searching for a safe harbor. Gold, the ultimate defensive asset, has been exhibiting highly anomalous volatility. If you only glance at the surface, you will just see noise. But as we decode this together, you will realize that the market is actually charging up for a new supercycle. Welcome to Market Decoded. Make sure to watch until the very end to grasp this roadmap of global liquidity. And don't forget to hit the subscribe button so you never miss our deep dive macro analysis. Part 2. Decoding the collapse of trust and gold's 2026 price action. To accurately anticipate the direction of institutional capital, we must correctly decode what the 1923 scenario actually means. When hearing this historical date, our brains automatically default to images of the Weimar Republic, wheelbarrows full of depreciated paper money. However, the core lesson of 1923 is not just the hyperinflationary numbers. It is the absolute and complete collapse of human trust in the monetary system. When confidence in government-issued currency hits rock bottom, the entire framework of asset valuation shifts. Capital loses its appetite for risk-on assets and empty promises printed on treasury bonds. It pivots violently, hunting for tangible, finite assets that cannot be manipulated or inflated away by central bank printers. Instantly, gold becomes the center of the financial universe. Look at the actual price data for gold in 2026. The current picture is incredibly complex, but packed with invaluable clues. Recall early 2026, when gold executed a spectacular breakout, smashing through the $5,100 ounce mark and touching $5,600 at its peak. An asset with a market cap as gargantuan as gold does not move that aggressively, driven by retail forces alone. Those were the unmistakable footprints of major financial institutions restructuring their risk portfolios. However, markets always move in waves. By May 2026, gold faced its sharpest monthly decline since 2008. The pressure came from a recovering U.S. dollar index, DXY, a higher-for-longer interest rate narrative that increased the opportunity cost of holding non-yielding assets, and margin calls in other markets, forcing funds to liquidate their gold positions to raise cash. Inexperienced traders hastily concluded the bull run was dead. Yet, the liquidity footprint at the $4,780 support level in early April proved the exact opposite. The buy-the-dip orders from heavyweights were still resting right there. The long-term bullish structure hasn't broken. It is merely undergoing a period of intense compression. Part 3. macro comparisons, and the hotspot of the physical market, COMEX. Here at Market Decoded, we do not rely on sentiment. To avoid getting swept up in herd psychology, we must directly compare current data with historical precedents. The similarities are undeniable. First, the monetary foundation is shaking under a mountain of debt that mathematically cannot be repaid without further currency debasement. Second, analyze the purchasing data of central banks. For years, they have been relentlessly sweeping physical gold from the market. When the rule makers, the ones printing the money, are hoarding hard assets, they are implicitly acknowledging systemic risk. Third, the fear index, VIX, and defensive posturing remain structurally elevated in the face of unpredictable geopolitical shocks. But the differences are equally glaring. The world today is not 1923. The modern financial architecture is equipped with numerous pressure release valves. The Fed and other central banks possess sophisticated tools like reverse repo and BTFP to inject or drain liquidity, effectively delaying a collapse. Furthermore, the U.S. has not hit hyperinflationary thresholds. Moreover, the dominance of algorithmic trading means news is priced in within milliseconds, creating violent whipsaws designed to shake out retail traders. Because of this intense noise on the spot gold chart, Market Decoded advises you to look at a far more reliable indicator: the stress on the COMEX exchange and the physical metals market, specifically silver. Silver is a smaller, less liquid market than gold, but it bears the weight of both safe haven and industrial demand. During highly sensitive periods, the premium between the physical price of gold-silver on the streets and the paper futures contracts widens significantly. When investors demand physical delivery instead of cash settlement, that is when trust is truly evaporating. The silver market often acts as the leading indicator, signaling an explosive move for the entire precious metals complex. Part 4. 4 macro triggers and 3 medium-term smart money scenarios. What specific conditions will trigger gold's historic breakout? According to our analytical models, it requires the convergence of 4 macro variables. 1. The debt ceiling is shattered once again. 2. A resurgence of supply chain-induced inflation. 3. The Fed gets trapped in a policy dead end, forced to cut rates to save the economy even before inflation hits the 2% target. 4. A massive capital rotation from pension funds and institutions into gold. Based on this data, Market Decoded outlines the 3 highest probability scenarios for the medium term. Scenario 1. The historic breakout, return to all-time highs. Inflation data cools down, and weakening employment reports force the Fed to aggressively cut rates, breaking the USD's uptrend. Institutional FOMO is instantly triggered. The velocity of the price action in this scenario will be extremely steep, offering no cheap entry points for those left on the sidelines. Scenario 2. The attrition sideways market, wide range whipsaw. The Fed maintains a higher for longer stance, but geopolitical risks persist. Gold gets trapped in a massive choppy range, e.g. $4,800, $5,200. This is the most toxic environment for retail traders using leverage, as constant reversals will hunt down stop losses of both the long and short camps. Scenario 3. The final washout, deep shakeout. This occurs if a black swan event causes a global liquidity shock. Investors are forced to sell everything liquid, including gold, to raise cash. Gold will experience a brutal short-term plunge, but for smart money, this will be the historic entry point of a lifetime before the new supercycle begins. Part 5. Risk management strategy and the confirmation signals. In financial markets, there is no one-size-fits-all strategy. Your actions must be entirely dictated by your capital posture. If you are a long-term holder of physical gold, turn off the short-term charts. The core function of gold in your portfolio is system risk hedging. A 5 to 10% fluctuation does not alter the global macroeconomic structure. Conviction is your key. If you are executing a DCA, dollar cost averaging strategy, capital preservation is vital. Do not go all in at a single price level. Tranching your allocations ensures you always have dry powder to accumulate if the market presents scenario 3, the washout. If you are looking to open a new position, do not chase green candles. Wait for technical pullbacks to solid support zones accompanied by drawing sell volume to optimize your risk-reward RR ratio. Set your alerts for these 5 critical macro indicators to confirm the breakout. A structural breakdown in the US dollar index, DXY. a sharp plunge in the U.S. 10-year Treasury yield, US 10Y, dovish shifts in the Federal Reserve's dot plot, interest rate projections, supply chain disruptions stemming from new geopolitical flashpoints, gold establishing consistent higher lows on the weekly chart, completely ignoring bearish news. The 1923 scenario may not repeat mechanically, but the structural risks it left behind are clearly reemerging. Gold is not a get-rich-quick scheme. It is the ultimate barometer for the failure of fiat currency. In this ruthless macro game, the winner is the one who can decode the data, control their greed, and execute disciplined risk management. If you found real, actionable value in this deep dive from Market Decoded, please hit the like button, subscribe to the channel, and share your thoughts in the comment section below. Invest wisely, and we will see you in the next market decoding session.